$100 billion. That's roughly how much U.S. stablecoins, dollar-pegged digital currencies, were transacted on-chain in a single quarter of 2025. But until mid-2025, there was no federal law that clearly recognized those coins as a legal form of money. On July 18, 2025, President Donald Trump signed into law the Genius Act, the first major federal statute providing a legal framework for stablecoins, a cornerstone of the crypto economy. At the signing, Trump vowed to make the U.S. the crypto capital of the planet. By writing rules by people who love your industry, not hate your industry. And yet, at the same time, the Digital Asset Market Clarity Act, H.R. 3633, remains in limbo in the U.S. Senate without becoming law. That bill was passed by the House and sent to the Senate, where it has not yet been enacted. So here's the urgent question. How can one landmark crypto law already exist, while another equally foundational one still hasn't been finalized? And what does that mean for crypto's future? That's what we unpack today. This is Unblocked Crypto, where we decode what's really happening behind the crypto market. To understand the significance of these laws, beyond slogans and headlines, we need to contrast what they say with what's actually unresolved. Stablecoins now have a federal framework in the U.S., but most other crypto assets and market structure rules do not. That split shapes where capital flows, where institutions invest, and where developers build. And unlike the common public perception, this isn't about banning crypto or letting it run wild. It's about defining legal status, agency roles, compliance structures, and risk boundaries. These laws determine who regulates what, which assets are securities versus commodities, how exchanges and brokers are supervised, what consumer protections exist, which institutions can participate with confidence. Without this clarity, markets don't vanish. They hesitate, investors wait, institutions hold back, and innovators hedge their strategies. That's the real impact. When people hear about crypto laws, they jump to one of these assumptions. This must mean total government control. No, these laws define boundaries, not eliminate freedom. They aim to transform legal ambiguity into structure. It must only affect bad actors. Not so. These laws affect every participant, from stablecoins to exchanges to token issuers. Regulation means prohibition. Actual legislation creates predictable legal ground, which encourages participation, not bans it. The key misunderstanding is this: regulation isn't about controlling crypto. It's about making rules clear if participants can operate confidently. Let's explore the two laws at play. The Genius Act, Guiding and Establishing National Innovation for U.S. Stablecoins Act, was introduced by Senator Bill Hagerty, RTN, and co-sponsors, and passed both chambers of Congress before being signed by President Trump on July 18, 2025. It's not an abstract concept, it's public law, 119-27, with specific requirements. Stablecoin issuers must maintain a full one-to-one reserve in U.S. dollars or highly liquid assets such as short-term U.S. treasuries. This one-to-one backing requirement was not universally mandated at the federal level prior to this law. Issuers must publicly disclose reserve composition monthly and undergo professional audits. For large issuers, for example, greater than $50 billion, annual audited statements are required. The statute explicitly excludes qualifying stablecoins from being treated as securities or commodities under existing securities and commodities laws, at least for payment stablecoin purposes. That shifts certain regulatory definitions away from default broad interpretations. Those rules are not hypothetical. They're written into law. At the ceremony, Trump said the law could be perhaps the greatest revolution in financial technology since the birth of the Internet. Federal Reserve Chair Jerome Powell, who historically voiced concerns about stablecoin risks, also publicly described progress on crypto legislation as a great thing and signaled that clarity would benefit the financial system. This is why the Genius Act matters. It converts legal ambiguity into defined legal requirements for stablecoins, a market with hundreds of billions of dollars in circulation globally. The Digital Asset Market Clarity Act, H.R. 3633, was passed by the House and sent to the Senate for consideration. Here's what the bill text and committee reports explicitly show. It defines regulatory roles between the Securities and Exchange Commission, SEC, and the Commodity Futures Trading Commission, CFTC. For example, digital commodities would fall under CFTC authority, while investment contract assets remain under the SEC. It sets out a framework for how digital commodity exchanges, brokers, and dealers would be regulated, including anti-money laundering rules and record-keeping requirements. It provides definitions for digital assets that don't default to being a security or commodity based only on historical tests, like the Howey test. These aren't vague policy goals. They are clauses in the bill text that would, if enacted, establish a statutory framework for token classification and market structure. But here's the catch. As of January 2026, the Clarity Act has not been enacted. The Senate Banking Committee has postponed its markup, delaying advancement toward a full Senate vote. And part of the reason is disagreement within both industry and political stakeholders about key provisions, including how broad CFTC jurisdiction should be and how decentralized finance should be treated. This means stablecoins have a law. Most other digital assets do not. That's a structural gap, not a headline. One of the strengths of the Clarity Act record is actual testimony from hearings, not just press releases. In committee hearings, stakeholders testified that the absence of a clear regulatory framework has caused some institutions to refrain from investing in digital asset infrastructure. Former CFTC Chairman Timothy Massad highlighted that clear statutory authority is necessary to empower regulators to innovate and protect markets. Legal experts testified that a federal framework would preempt conflicting state laws and bring consistency. But even within these hearings, voices diverged. Some industry representatives argue that the current draft goes too far in regulatory scope, especially around decentralized finance and tokenized equities, which contributed to the Senate delay. Those are real debates, not abstraction. Let's narrate this like a story. Early 2025, lawmakers try for foundational crypto laws. The Genius Act and Clarity Act begin movement through committees. June 17, 2025. The Senate passes the Genius Act 68-30 with bipartisan support. July 17, 2025. the House passes both the Genius Act and the Clarity Act. July 18, 2025, President Trump signs the Genius Act. But late 2025 into early 2026, the Clarity Act stalls in Senate committees, not due to lack of relevance, but due to disagreements about language, regulatory jurisdiction, and industry impacts. That's a legislative pause, not a scrap. 1. The Institutional Investor Wallet. This wallet wants clarity on custody rules, custodian fiduciary standards, market structure certainty. Institutions have publicly stated they need statutory definitions to commit capital at scale, not guidance memos. That perspective came out in committee testimony in House hearings. They don't want guidance, they want law. 2. The exchange/broker wallet. Exchanges want predictable rules on trading supervision, broker registration, AML requirements, cross-border compliance. Without clarity, the language around digital commodities versus securities matters greatly because it determines which agencies' rules apply to them and how their platforms must operate. 3. The DeFi Protocol Wallet. This wallet cares deeply about whether the Clarity Act draft creates burdensome registrations for decentralized platforms, a concern many voices in industry voiced in Senate discussions, and is part of why markup was delayed. 4. The Stablecoin Large Issuer Wallet. This wallet now has a law, Genius Act, which means it knows it must maintain regular audited reserves. It knows it must report transparently. It knows its product isn't automatically a security. But it also knows that broader market rules are still undefined. This split, law for one class of asset, no law for the rest, creates asymmetric certainty. How do these legislative frameworks shape markets without prescribing outcomes? Legal clarity reduces risk premiums, making institutions more willing to engage. Genius Act's reserve and audit requirements cut uncertainty for stablecoin use. Defined jurisdiction facilitates compliance. If the Clarity Act passes, firms will know whether the SEC or CFTC applies. Ambiguity today means dual risk exposure. Rules create operational standards. Standardized exchange and broker rules reduce operational friction. Transparency obligations build trust. Public reserve reporting and audit standards foster greater confidence among users. None of these guarantee prosperity, but they shape incentives and risks. In traditional finance, deposits, bonds, securities, legal frameworks have existed for decades. The stablecoin market didn't have that until Genius. In contrast, equities and bonds operate under securities laws, SEC disclosure obligations, clear exchange regulations. In the crypto world, those rules haven't been fully codified yet. That's the gap the Clarity Act is trying to fill. Without this dual framework, one for payment instruments, stablecoins, and one for market infrastructure, the regulatory environment remains inconsistent. As this episode moves toward its conclusion, consider these long-range structural effects. 1. Regulatory authority lines will shape market leadership. If the Clarity Act passes in some form, it will define how the SEC and CFTC divide digital asset markets, a question that has vexed legislators for over a decade. 2. Consumer protection standards will evolve. Written statutory rules ensure protections are consistent nationwide. unlike enforcement-driven regimes that vary by case. 3. Global positioning matters. Other jurisdictions, Europe, Asia, are moving on crypto law as well. If the US finalizes both stablecoin and market structure laws, it could influence global regulatory alignment. 4. Innovation versus compliance balance. Lawmakers continue wrestling with how to protect consumers without stifling innovation. Attention visible in Senate debates over the Clarity Act's scope. Here's the question for crypto's next decade. When the law finally defines digital asset markets, who will shape those rules? Lawmakers accountable to voters and public hearings, or regulators and courts through individual enforcement actions? That's the structural choice facing crypto today.